let's talk a little bit about our positioning and our views on equity markets and bond markets, Jonathan. So, we've discussed for the last 20 or 30 minutes about how we feel about recession and interest rates and whatnot. What's your view on the state of equity markets and looking forward? What do you think?
Yeah, Eugene, I think the equity markets are about as fascinating as I've ever seen them, and we've seen this extraordinary concentration, and everyone knows about this. I'm stating the obvious. The so-called Magnificent Seven, it became the Magnificent Six because Tesla started underperforming, and suddenly Tesla rose from the dead. I'm not quite sure how they've done it, and Tesla's been a standout performer just in the last 3 to 4 weeks, and Apple actually has also performed quite well for various specific reasons. But bottom line is, the US stock market has been led by one company, which is the greatest company the world has ever seen, and it begins with N. It's called NVIDIA. We all know the narrative. We know the story. I've been personally very, very excited by that name and the whole AI revolution. But NVIDIA is taking a bit of a rest, and so some of the others are picking up the slack. But the bottom line is the kind of dispersion and relative performance in the United States that we're seeing today has never been seen before. I really choose my words very, very carefully. I was very much part of that 99 situation. I saw Cisco become the most amazing company, and then we saw what happened next. By the way, just for the record, NVIDIA is not Cisco. NVIDIA is an amazing company and actually will continue to perform remarkably well. But everything gets to a point where you kind of say, okay, fine. I love the company. I love the fundamentals. I love the earnings prospect. But what about the multiples? What about the share price? Up 157% year to date on NVIDIA, the locomotive of the US stock market. And I think, and I articulated this in my most recent report, that we're getting ever closer to that kind of zone of big price fall perfection in terms of the United States. It's a momentum-driven market. I understand that, and I respect that. I understand that those big names, whether it be an Apple, a Microsoft, a Google, an Amazon, an NVIDIA, obviously, or even a Tesla, it's one of those situations with everything that's going on in Europe, for example, what's going on in China, for example. Global investors look at the United States and they say those big tech stocks are the prettiest house on a really ugly global street. I get all of that, but valuations are stretched. Anyone would have to acknowledge that. And the longer we're in this game, Eugene, the more we need to respect those extremes, because valuations and price earning multiples are like rubber bands. And they stretch. And everyone says, it's fantastic. Everything's going to carry on. And then woof, they come back in. So I think the price earnings multiples in the US are somewhat stretched. I think clearly we've seen a massive dispersion between small cap, large cap, and within large cap, we've got this concentration within those spectacular 7 names, the so-called mega tech and mega caps. I'm more cautious on the US because of that valuation multiple. And as I said, I think we're kind of in that zone of being priced for being priced for perfection. With regard to bonds, I've been kind of neutral for the balance of 2024, and the portfolios, have become more neutral. They were quite overweight duration, and they've been now moved back to a more neutral setting. And I think they've done quite well out of that, because bond yields have actually risen in the last couple of months. And those changes were implemented over the last several months to move to a more neutral setting in terms of the modified duration profile on the portfolio. So I think that's worked reasonably well. The debate around bond yields is predicated upon the following. We've got this tug of war. What is the tug of war? The tug of war is we've got the United States with a big budget deficit, very high levels of debt. We've got the Congressional Budget Office, which is a nonpartisan organization, basically saying or ringing the alarm bell on excessive debt in the United States, ringing the alarm bell on the interest cost, which is now annualizing at $1 trillion. So about equivalent to defense spending, or actually exceeding defense spending around now. So the CBO is saying the path that the United States is on is an unsustainable one. The fiscal path is unsustainable. So the US Treasury has to keep issuing more treasuries. Excess supply, all things equal, drives up yields. On the other side of that, what's the demand side of that equation with respect to US Treasuries? On the demand side, first cab off the rank is the US Central Bank, the biggest holder of US Treasuries, and we know they're implementing quantitative tightening. So they're reducing their holdings in US Treasuries. The next one, of course, is Japan and China. China has been reducing its holdings in US Treasury securities, and Japan's been kind of neutral, but slightly reducing their exposure. Then you've got households in the US, and their exposure to treasuries has been building. Why? Because, of course, we've seen this ratchet up in the yield. So, for example, money market funds in the United States have big exposures to US Treasury bills, because US Treasury bills now offer 5.35, 5.44%. So that's nice. That's a positive. So we've got this constant tug of war, and I'm kind of neutral because I respect the budgetary fiscal arithmetic and the impact, commensurate impact on bond yields, shifting them slightly higher. But on the other side, I see households being quite happy accumulating, particularly short-dated treasuries, because they offer quite attractive yields. And also, don't forget, we've got the economic slowdown story happening as well. So I think it's a kind of balancing act. Yeah. And I think the portfolios did quite well to move to a more neutral stance over the last couple of months.
Yeah. Thanks, JP. And yeah, and I guess that's reflected in our allocation. So, you know, we remain fairly neutral with respect to bonds. Well, bonds with longer fixed duration, so long-term fixed rate bonds. And I think you summarize it really well in terms of the fact that there's two sides to that story, and it's hard to know exactly which is going to prevail. But on the one hand, you know, locking in 4 or 4.5% for 10 years seems attractive, because I think over that period, probably rates come down, perhaps even if they stay higher a bit longer than expected. That's the thing. A rate rise or two, or a rate cut or two in the short term doesn't have a huge impact on the 10-year rate, right? So we remain neutral. And as we said in April, we did reduce our exposure in April to duration in both strategic and tactical. And then we reduced it a little bit further in tactical in May. Going back to equities, and it's another interesting conundrum. You've got valuations which are stretched in the US particularly, but then you've got and then you've got that story of, you know, these gigantic 6 or 7 stocks in the US that seem to be accounting for a lot of the upside in the US indices. But then you've got, you know, like the Russell 2000, for example, which is a much broader index. It's 10 or 15% below its all-time high last time I had a look. So the smaller end of town, you know, hasn't performed as well. A lot of it has been that those really gigantic tech stocks. So it's tricky. And but, you know, and then you've got all the geopolitical risks, the stretching of valuations, the economic risk. So we remain cautious in our portfolio approach. I think also, and I think we explained this in April, our quality bias. So we want to be invested in managers that will buy quality stocks, so that if there is, you know, an economic shock, or there is a geopolitical shock, that those companies that have stronger balance sheets and a bigger and have a better business strategy will survive. They might be volatile, but they'll survive. And you won't, you know, the risk of long-term or permanent capital loss is much, much lower, which is what we want. But we also maintain an underweight position. So we also, in the last few months, we've done a little bit of extra buying in tactical. We've increased our equity exposure a little bit. And we've now added an exposure to global REITs. So global property has, has taken a hit, hasn't performed in the same way sort of over the last 3 or 4 years that equities have. And the tactical portfolio didn't have any exposure to global REIT, so we've added a bit. So, and it's again trying to strike a balance between how resilient markets have been to all the risks and those stretched valuations. If there is a contraction in P multiples, perhaps some of those quality stocks might take a hit because some of those valuations are also stretched, although not crazy stretched, because when you look at the earnings prospects of some of those companies, particularly companies like Nvidia, they're quite amazing, right? So because of what they're doing, the sort of businesses that they run, the fact that Nvidia doesn't really have a competitor, at the moment. They will over time, I would say, but for the time being, they're sort of they sort of can set their own pricing and whatnot. So you got a lot of things happening there. So we remain cautious. The tactical strategy is still very underweight. We've just moderated that underweight position a bit in light of the fact that we're probably a bit more, probably a little more optimistic, and sort of in respecting the fact that markets have been fairly resilient, right? But there's a lot of risk out there, and valuations are stretched. So we're still maintaining a significant underweight position, and we'll probably continue to drip feed back into the market. Obviously, as I've said, the tactical strategy does take a short to medium view, so that can always change, right? But for the time being, we're sort of moderating that underweight position a bit, but still remaining quite cautious and underweight in our growth exposure. And in SAA, in the strategic strategy, we haven't actually made a change since those changes in April, but we are reviewing a few of our holdings, a few of our funds. We are potentially looking at a global small cap allocation, and we're looking at a few other bits and pieces. So we'll probably have a little bit more to say around the strategic strategy at our next update in 3 months' time. But that's kind of how the portfolios are positioned. It is a difficult environment because, as I said, there's two sides of it. There's a lot of positives and a lot of negatives, and it's difficult. So we want to be diversified, and I think you want to have a quality bias at this point in time.